Good evening to all the participants. Welcome to this program on risk and treasury. This is the third day, and this is treasury management, going to be a very specialized subject. And people work mostly in branches. Only very few people get a chance to work in very skilled job like treasury, risk management. And I was fortunate enough. God was very kind to me. I had an innings in all three distinguished specialized areas of bank. I worked in forex, I worked in treasury. Subsequently, at a later stage, I worked in risk management. So this is a combination. I had an occasion to work as chief dealer forex of my bank from 95 to somewhere 98. Then again, I had an innings in integrated treasury as a chief manager back office. Then I had an innings as chief dealer in domestic treasury. All these things I worked, and with this knowledge, I think I have also gathered some knowledge. I should not say I have acquired a very big knowledge, and I am presenting today what is treasury, what is how we have to go, and this is going to be my introduction. Introduction. What I am going to cover today is what is treasury, functions of treasury, in that funds management, forex management, interest rate risk management, transfer pricing mechanism. Is treasury presently a cost structure or a profit structure? This what? And I thought of including integrated treasury today, but it will go overboard. That's why I'm restricting with this. So let us dwell deep on this subject, and we'll go slowly also. And anybody has got any doubt, please stop me, and I will hear and I'll answer the questions. Any doubt you have got? If you go back, how this treasury concept has come. You know, everybody know that government is collecting the tax. Government cannot be present everywhere, it cannot. So it has appointed somebody to collect the taxes, the funds on behalf of the government, and it has to be handed over to the government for doing the welfare measures. This is how the treasury concept has come. I still remember some 30-40 years back, they used to call Huzur treasury, and every district used to have treasury, every taluka used to have treasury. This was the starting point where government's funds management was done. At that time, the economy was not so matured. Individuals may not have so much of money, so that the funds management has to be done. Even when I was working as industrial finance branch, the first branch I worked as a deputy manager there. At the time, I'm talking of 91, 92, when proposal used to come, at that time people never used to say because crore looks very big. So they used to say crores in lakhs only. So I'm taking some 30 years back, crore has so much of value. But nowadays, you want to buy a flat in Mumbai, in any a two-room kitchen, it costs more than 1 crore. It means we have got more crore patis nowadays. So crore is, I will not say a value, probably India's progress in such a way, more crore patis are there. So I'll come back to treasury. The treasury concept came, government used to pool funds, and then it used to spend. This was the concept. Then again, government found that they are not able to work very fast or efficiently. Some professional approach they required. Then this work was hived to State Bank of India. Or I will say that if the State Bank from India, the previous name was called as Bank of India. State Bank is the only commercial bank which worked before Reserve Bank. It used to work. It used to have the role of the Reserve Bank of India. When 1934 RBI came, State Bank became a commercial bank. Then again, what the government said that let us give the entire government work to RBI. So RBI used to collect the funds, and it used to give it to government for spending. Now the problem with RBI is that RBI is not present everywhere. Probably it is present only state capital. Then this power was delegated against State Bank, because State Bank is present everywhere, and almost district head, wherever every district headquarters are there, State Bank used to be there. This treasury function, collection of taxes, all these things, they used to get the challan, fill up, and remit it. This is called the treasury work, and it was given to State Bank of India. When 1991, after liberalization, we said you go back to 1991, now our Sensex has crossed 60,000 and all that. Go back to 1991, Sensex has not even crossed 1,000. It was 800, 900 level. Now, see the fund. Why I am telling this, funds movement has increased. It means the circulation of money has increased. Funds movement, we have seen everywhere funds movements are there. With the result, what happened? Everywhere the funds started gathering. So with the result, every bank, they wanted to concentrate on the funds movement. So they wanted a specialized setup. So that setup is treasury. Before 1991, normally, I'm talking about the culture of Union Bank of India, we had a mother branch called BSMR. There we used to do all the forex transaction, and your CRR, SLR maintenance. It was there even before 1991. It used to be maintained in the head office. There used to be a department called investment department. It is a part of the head office or central office. They used to do all this function. It means there was no connection between these two departments, and forex will work separately, the investment department will work separately. They don't know what is going on between this. But one thing what I say, that even though forex is working separately, investment is working separately, the common thread is the rupee. Whatever the inflow or outflow, I buy dollar means I have to give rupee. When I sell dollar means the bank will get rupee. It means the common thread that is running in the treasury is rupee. So funds management should be in rupee. So now from government, it has come to State Bank, Imperial Bank, again it has come to RBI, and then from SBI. Now government started giving all their portfolio to all the public sector banks. With the result, the funds management started after liberalization. We have seen that cross-border transactions have increased, export-import has increased. People used to borrow from abroad through ECB routes, or FDI started coming, or foreign portfolio investment started coming to India. And most of the US and everybody, they saw that since our interest rate is more, we started attracting a lot of capital from them. So this cross-border flows has increased the funds management. With the result, every bank thought that we must have a centralized treasury. So with the result, all banks started having a treasury. And one more thing, if you remember, State Bank had its treasury in Calcutta. But the financial capital of India is Mumbai. Every bank started centralizing the treasury in Mumbai. With the result, State Bank also finally came to Mumbai. So if you see, all the dealing rooms, the major dealing rooms or the banks are situated in Mumbai, being the financial capital. Now, this is what the introduction for treasury. If you go back to treasury in US, advanced country, and even today, everything we look for US only. If you go back to 10th February 2022, suddenly your Sensex has fallen by 1,050 points. One day fall, and everybody started, why this fall? Because there is a thing that US is going to increase the interest rate. Now why people are coming to India? Because our rate of interest is more, whereas United States of India, their interest rate is low. That's why the flow started coming to India. Now US itself, they are going to raise the interest rate. What the apprehension is that probably the funds move may not come. That's why the Sensex has tanked on that day. So the forex market will not be complete without study of the US market. And go back to US, they are the forefathers. They had a good treasury setup, and they had all the, like now today, if you see in India, there was a question why private corporate bonds are not coming up in India. The question is that the government bonds crowds out the entire investment. That is one of the reason we see that the private corporate bonds is not maturing. The same thing applies to United States. Even though it's a big market, there also the government market is very big. They have got like our market. Probably we followed their system. They have got a treasury bill. They have got treasury note. All these things they have got, and all the handled at the treasury. Okay. Having given the introduction, the primary question is, what is treasury? Why treasury? If treasury is not there, what will happen? Treasury is a place where funds are collected. Probably a deposit keeps accruing in Kanyakumari, or a deposit keeps accruing for a bank in Calcutta, Ahmedabad, Delhi. Wherever the funds comes, all the funds should come to one common kitty that is called treasury. From there, the outflow takes place. This is called centralized treasury, because funds management has to be done. Suppose I'm asking somebody, you give me 1,000 rupees, I'll pay you tomorrow. Tomorrow, even before he is asking, I should pay it. That is called my status, my respect. The same thing holds good for a bank also. Suppose deposit is maturing today and the customer comes. If you say that, no, sir, today deposit, we are not able to manage the funds, come tomorrow. Then bank's status has gone down. So who has to manage all these things? This is a liquidity problem. Who is due? And we cannot throw this to the administrative office or to a branch or all these things. You must have a centralized funds management system so that they can track all their inflows and outflows, what takes place, they should see. And they should also keep some buffer. Because if you take Indian history, the fixed deposits are not fixed deposits. They may put the fixed deposits for 5 years, 3 years, but after 6 months they come and ask you repay. I want prematurely close. You cannot say no. It is called embedded optionality. It means nowhere it is written. But when the customer comes, they ask for repayment, it has to be paid. At this time, the branch cannot say, I don't have funds. So it is for the treasury to arrange. So one fellow in a bank who want to hold the responsibility for fund management, that is treasury. Treasury is responsible for funds management. Now, what is funds management? Keeping optimal fund. Telling optimal fund is very easy, but proving optimal fund is very, very difficult because that comes only by trial and error method. How much buffer I should have? From Bangalore, you are going to Pune, you are going to Mumbai. How much money you are going to carry? Are you going to carry only the freight charges or your ticket charges for your Kana? Something you are going to bring surplus. How much surplus you are going to keep? So for an individual person, deciding the surplus is difficult. Take the case of the State Bank of India with 28,000 branches, 30,000 branches. How many branches you will have premature closure of deposit? All these things is to be factored, and you should not say no. The moment a bank says no, then it goes into reputational risk. Reputational risk and indirect risk. It is not a direct risk. If you don't manage a credit risk, reputational risk comes. If you don't manage your operations properly, reputational risk comes. Uninvited guest is reputational risk. Buy one, get one offer. I don't manage my market risk properly. You need not invite. Automatically, your bank's name comes. Tomorrow in the paper, this is what has happened. So the funds management is so essential. So treasury is a place where funds are moving in and out. Sometimes, what do you mean by funds management? Keeping proper. Suppose I'm telling you optimum. Optimum means if you are going to give more surplus, idle cash never earns any interest. That's the problem. There is always a trade-off between liquidity and returns. In returns, you must keep less cash. That cash should be invested somewhere so that it earns interest. But at the same time, if you are going to park entire money and there is no surplus left, suddenly some premature closure of deposit comes, where from you are going to pay? So you have to keep a buffer. Suppose you are going to keep more buffer, you lose your yield because idle interest earns no interest. At the same time, if you are going to keep very short money, you go into a reputational risk. So it has to be, there's a trade-off. This has to be balanced on daily basis. Probably 2020 optimum balance may not hold good for 2021. It has to be dynamically see. You must see the behavior, how the deposits are getting premature closure, how the renewal factor. All these things has to be factored in keeping the funds. Okay, so surplus funds has to be managed. There should not be shortage of funds. At the same time, any premature closure, any sudden demand, you have to meet. Suddenly, let us think that today there's a very tightness. We have to borrow in call money, or we have to lend in call money. All these things treasury has to manage. Okay, so treasury is responsible for managing the funds of an organization. If one fellow is to be crucified for not managing the treasury, not managing the funds well, that is treasury. You need not fix the responsibility or account to anybody other than treasury. So treasury comes in the funds management. So one more thing. Now, if you see treasury, government treasury is there, corporate treasuries are there. Our focus of study is going to be treasury attached to a bank. Okay. Now, why I'm telling? Because slight differences are there. For a corporate, for him, he is raising the loan, that money has to be invested. For a bank, that funds comes mainly, the source of money is deposits. What is banking? Accepting deposit for the purpose of lending. That's what the banking experts have put accept, because first I want a source, then only the application can take place. Suppose today we accepted a deposit and it is not invested, then the meter is already ready, because the moment you accept a deposit, you have to pay the contractor rate of interest. The deposit is not bothered whether this fund is utilized or not. So it means, ideally speaking, every deposit should marry an advance. Then only your net interest margin will be very good. But we cannot say when the deposit is ready, the advance flow will also be ready. We cannot say. Sometimes deposit has come, advance people are not there. So what we are going to do? What treasury will do? So it has to invest this fund somewhere. You require a market, separate market. You cannot again invest this funds for long term, 5 year, 3 year. We cannot, because it has to be short term. Because movement advance fellow comes, this whatever is temporarily invested has to be withdrawn and it has to be given to an advance fellow. One more situation. Deposit is not accreting for some reason, but you have got a very beautiful or very good, very highly credit-rated borrower has come. Branch has sanctioned, or zonal office, regional office sanctioned it. Now he is coming for an withdrawal. Sanction can be given. Sanction is something different. Disbursement is something different. But the moment it is sanctioned, naturally it will come for a disbursement. At that time, you should not say no, because getting a good borrower is difficult. At that time, if you are going to say no, that fellow is not going to wait, because in a good borrower, there is cherry picking. There are other banks to pick him. So at that time, what treasury has to do? It has to borrow from somewhere, give the advance. When the deposit comes, the temporary advance, the temporary borrowing is to be closed. This is called funds management. This is a big challenge. Telling is very easy. If you go to sit in a treasury, suddenly you will say, the big withdrawal has come, sir. Okay, borrow. No, sir. Now that after having borrowed, you say, no, sir, he's not withdrawing today. Now you cannot say, sorry, by mistake I have withdrawn. That funds become surplus. It has to be invested there. Because we follow a branch banking. Sitting in central office, head office, controlling 1,000, 2,000, 3,000 branches is very difficult. And funds management is still tighter. It is a tightrope walking. So this is called, one fellow who is responsible for funds management is treasury. That's why every bank has gone for a centralized treasury. Like how you are constructing a dam. Why dam is constructed everywhere? Because when the rainwater comes, it is getting collected there. Same way funds are collected in treasury. And from there, wherever you want, the dam channelizes through that. Probably rainy time is something different, harvesting or cropping pattern is something different. Till such time you have to hold a water. At that time the water is to be released. So I always say a treasury is almost close to a dam. Dam is reservoir of water, treasury is reservoir of funds. That's all. But only thing is that we cannot say that in funds management, when funds need comes, the treasury cannot say no. It has to give. At the same time, you should not keep surplus also. Because if you are going to keep a surplus more than required, to that extent, the yield of the bank comes out. Okay. Let us think, I take a small case. Suppose Canara Bank Santa Cruz, because I know many Canara Bank people are here. It has accepted a 1 year deposit at the rate of 4.5% for 20 lakhs. Today it has come. Let us think that he has given a check, or it is a transfer, or whatever it is, or it's a new deposit coming. Whether this money is going to remain with the branch? No. Only the money comes. From there, all this money are collected. I used to work in small branches. There used to be a cash limit. Whatever the surplus cash, we used to remit in State Bank of India. From State Bank of India, we used to give a TT transferring this to Bombay. This is what every branch is doing. There's an instruction. You keep whatever there. If it is a cash, remit to State Bank of India. If you have got a clearing surplus, automatically it is getting credited to your State Bank account wherever, because most of the places State Bank has a clearing member. or State Bank holds the cash chest. So these are, even though the deposits are accepted, the funds are coming to the branch, finally all these funds are transferred to centralized to Bombay. So it means all pipes, where are different pipes, it gets united at treasury. Wherever the water comes, it comes to the dam. Same way, wherever the fund comes, it comes automatically comes to treasury. From there, the cash flow outflow takes place. Okay. Now tell me how many treasuries a bank should have. In fact, during my days, a Union Bank had 4-5 dealing room. We had a dealing room in main dealing Mumbai, Cochin, Calcutta, Delhi. We had a dealing room in a place called Badoi, called Kalin Nagar, because export used to be very high. Then funds management was, they are finding it very difficult. So all the banks started, okay, let us close all the dealing rooms. Let us have one or two. Why two? Business continuity policy. Suppose financial capital of Mumbai is always a risky area. That's why some problem comes, the treasury operation should not be stopped. So if you take Union Bank, we have got a standby dealing room in Kochi. Suddenly any problem comes, we can airlift our dealers also. Some minimum facilities, some minimum transactions are going on. That's why if you see some banks, they keep minimum 2 treasury. One is a main treasury, another standby to support the business continuity policy. And as I told you, funds collected at branches can come to treasury through various means. Remit cash to State Bank, give a TT. Or clearing becomes high, you get a big clearing, favorable clearing, transfer the funds. Or it can come through nowadays RTGS, NEFT, all mechanisms are there. Okay, all will come. So the first and foremost function of treasury is funds management. Okay. If you have got any doubt in funds management, you can ask me. Otherwise, I'll go to next. The next foremost department of the function of treasury is maintaining reserves. In India, mandatorily, a bank has to maintain 2 reserves. One is cash reserve ratio, as per section 42 of RBI Act of 1934, and every bank has to maintain 18% of their deposits in cash, gold, or government securities. This as per section 24 of your Banking Regulation Act of 1949. The CRR and SLR balance has to be maintained. You cannot say, sorry sir, thoda kam ho gaya, bear with me. No question of that. If the compliance means compliance. Sir, 1 rupee shorter, 2 rupee shorter, no. RBI strict on that. You have to maintain. That's all. There is no other go. So this responsibility again comes on treasury. They have to collect, yes, some data support, computer management, somebody will help you, will help the treasury. They will tell how much to keep. But based on that, it is the duty of the treasury to keep the CRR funds are kept with RBI. Every bank has to open a current account with RBI, and the CRR funds have to be parked there. And one more thing, this 18% of SLR, again, most of the banks, why all banks prefer to keep it in government securities. Why they want to keep in government securities? If you are going to keep as cash, it is not going to earn any interest. If you are going to keep in gold, same thing, gold is a dead asset. There can be a capital appreciation, capital depreciation. If you see gold in the first week of February, you see that the gold prices has fallen. There is heavy withdrawal in exchange traded gold, that exchange denominated gold, heavy withdrawal is there for till the first week of February. So every bank prefers to keep their SLR in government securities. There are 2 reasons. Government securities attracts no capital. So to that, any asset, you have to keep a capital as per Basel norms. Yesterday, madam was telling. So if it is a sovereign security, we need not keep any capital, and you get some interest also there. So it's a win-win situation. So this statutory presumptions, compliance of keeping CRR and SLR is on treasury. Okay. And I have told treasury is almost equivalent to a dam, because dam is a reservoir of water. Whenever you want, you can use it, and whenever surplus, it is stored there. Same thing, treasury is a reservoir of funds. Whenever your surplus is there, somewhere it is invested. Whenever shortage is there, they borrow somewhere and they give the whatever the loan, then when the deposit comes, they close it. Why? What is treasury management? Having said what is introduction, what is treasury, what is the prime two role of treasury? One is funds management, and it is complying with the statutory presumptions. And what is treasury management is funds should be deployed in an efficient manner. Telling is very easy. You should be deployed efficiently, promptly, and you should. But challenge comes in implementation. How to prove they have done efficiently? Between two banks of equal size, the market is same, the atmosphere is same, the environment is same, almost equal size bank. One bank's NIM is more than other bank's NIM. That itself proves that it's an efficient management. And one more thing, in proving funds are deployed efficiently, treasury is not solely responsible. Because efficient management, it includes giving loan, higher the NPA, lesser the NIM. So if idle funds are kept in the treasury, not properly utilized, again the NIM will come. There are a host of factors to prove that whether bank is efficient or inefficient. Very easy to say efficient, but in implementation, big challenges are there. Okay, so what is the final thing? Treasury has to raise the money cheap and employ the same in a source which is gainfully. It means treasury accept at a lower rate of interest, that is lent at a higher rate of interest. So the margin, the spread is getting. That is called treasury management. I have already told what are the challenges for treasury. When deposits are more than advances, treasury has to find out ways to invest the surplus funds. Because on the liability side, the bank is paying interest every day. That's what Einstein he said. The eighth wonder is compound interest. You and I can sleep, but interest will never sleep. Interest is there. It is awake by 24/7, 365 days. So having accepted the deposit, if you are going to keep a surplus without utilizing the same, then that money goes waste. So when surplus, bank has to pay interest to depositor, but earning may be lower than the deposit. Whatever you are going to interest, what is that market? I'm telling, somewhere they have to invest, or when sometimes shortage is, somewhere they have to borrow. That market is called money market. Money market is a temporary market created mainly by banks. Subsequently, many players have started coming. Mutual fund, primary dealers have come. But originally, if you see the origin of money market, it was the brainchild of banks. Because when surplus comes, where I will invest? Somewhere a market should be there. Suddenly, shortage is there. Where from you have to borrow? You cannot go to a capital market and borrow. You require SEBI's permission. You have to issue shares. All the long process. So you require a quick market to borrow or keep your funds. That is called money market. So surplus, invest in money market. Shortage, borrow from money market. So this is how the funds are managed in treasury. Oh, the above concept is called funds management. Okay. Now I have been harping. There are host of risks. Dunya bhar ka risk hai. Everywhere risk is risk is present everywhere. Risk always looks for the weak spot to enter. Risk has no kindness. No, he is a good fellow, I should not attack him. No, he is a bad fellow, I should attack. No, it is not like that. Risk always encircles you 360 degrees, and it always looks for a weak spot to enter, to create an opening. And I always say liquidity is the highly poisonous risk. It's ICU risk for the bank. When a patient is admitted in ICU, we say that in ICU you have to be there for 3 years, 4 years. We will become bankrupt. They say when the moment somebody goes in ICU, it is in hours. Same thing, liquidity is in hours and days only. That's why yesterday Madam was in liquidity coverage ratio. If a bank survives the liquidity threat for 30 days, then RBI said that you are sound. Any attack is only up to 30 days. If you manage a liquidity risk, you can manage forever. I'm talking of liquidity risk only. Liquidity is a short-term, highly poisonous risk. If you want put number of risks are there, which is most poisonous, like your king cobra is the highly poisonous. A king cobra, when it bites, even elephant dies. Same thing. Liquidity risk is such a bad risk, and we have seen number of private banks, they were in liquidity risk. We have seen two banks somewhere in 2019, and one private bank we have seen in 2002. All this, there was a run on the bank. The moment depositor lose confidence, they will say that no, mine is a good bank, sir. Your bank is good. Pehla paisa de mero. This is called liquidity risk. So liquidity risk is a big challenge. It has to be controlled, it has to be mitigated, it has to be monitored. All these things has to be done. Again, what is the definition of liquidity risk? There are two definitions. One is a soft definition and the odd. One is going concern and the gone concern. Going concern, a bank is able to manage the liquidity risk. How it will manage? Suddenly some commitment has come, it will, you have got in your house, jewels are there. Jewels you are all selling at a throwaway price. Same thing, all the assets, probably surplus SLR, whatever it is, they have to sell at a cost, with high haircuts and manage. That's called soft definition. Bank meeting sudden arising commitment by incurring heavy cost either out of borrowing. At that time when you are in problem, nobody market has no, it's a good bank, let me give call money at low. No. The moment you are in problem, the tightness comes, they say, I am ready to give you by my call money rate is 20%, 30%. So you have to borrow at high rate of interest or sell the asset at a depressed price. Because they know that this fellow is in problem, anyhow it is going to sell. So the market will demand a very low price for the asset. But still you are managing the liquidity risk. It means you have overcome. The bank survives. That is called soft definition. In the hard definition, bank is not able to meet. The moment bank is not able to meet, then it goes into reputation. Tomorrow morning it will come in the paper. Inability of the bank to meet the sudden arising commitment in time to the outside world or any third party. This situation, I'm not telling every bank is going to go into liquidation, but finally it may lead to the run on the bank. Hard definition. Soft definition is borrow at high cost, meet the commitment, or sell whatever is surplus funds at a low cost and meet the commitments. Soft definition. Or the second one, I am not able to pay today. Hard definition, inability to meet. Then there are a lot of problems there. Then RBI also intervenes. Why you have said all these things will come into play. Having talked about liquidity risk, again liquidity itself a big cobra. It has got three sub cobras under it. There are three subcomponents. One is called funding risk, time risk, call risk. I believe yesterday madam was covering all these things. Because liquidity is the main risk that is coming in treasury. Now I have to cover this also. At the cost of duplication, I am also covering this. What is funding risk? Funding risk is all term deposits, even the accept was 6 months, 1 year, 3 year, 5 year. It is not. It is left to the discretion of the depositor to keep the deposit of the contract period. But he wants premature closure. No force on the earth can say, no, I will not. During Dr. Raghuram Rajan's period, he came out with a fixed deposit called non-premature closure deposits. And he said that for that banks can pay little high rate of interest. But it has to be explained to the depositor, and the depositor selling the product and customers should sign that contract. It cannot be premature. It is just like that. No, customers are putting a section 80C, they put 5 years money. If afterwards, if the depositor comes and asks the money, will you be able to pay? You have to say no. Same kind, non-withdrawable deposit. But it does not find the favor of depositor, because depositor want democracy. It's my money. Even though I'm locking at 5 years, anytime I can come. No, I don't want to lose the democracy or this privilege. I don't want to lose this. I'm ready to lose 0.5%, 25 or 0.25 basis point, but I will come. Still worse, he is keeping the deposit for 5 years, but he comes for a loan on that. Every bank considers 90 to 95%. Again, this is a cash outflow for the bank. This is called funding risk. Funding risk arises out of a liability product. Next is time risk. This has actually happened in Kingfisher case. Many banks. Kingfisher was to, I'm talking of 2000 somewhere 12, 13. Kingfisher was to pay heavy amount. All are expecting he is going to repay. So when heavy inflow comes, that inflow has to be met with an outflow. Otherwise, this fund will remain idle. So expecting the inflow, banks commit. They release housing loan. Monday you come and collect the check. Monday I'm releasing you. You are giving a promise to the loanee. Sanction is there. We are getting a heavy inflow. Out of that, this cash outflow will go out. Now you have promised the loan party or borrower, you come and draw the money on Monday. This promise was given on Saturday because you are expecting a big repayment from a big borrower. But on Monday, he said that I am not able to pay. Sorry, I cannot pay. Because if you go to a corporate, one day default is called default. Any corporate bond, if it is not paid on today, tomorrow it is called as default. But when India or international norm for a bank, today it is difficult because you have to gulp it. Because today if the funds are not coming, tomorrow it becomes overdue. A 90 days overdue, on 91st day only this account becomes NP. It means even though we are expecting the funds tomorrow, still we are allowing him to pay in 90 days time. So borrower jolly will take the time. But having committed to a loan party that I will give this, tomorrow I will disperse, you cannot go back on that. So again it creates a liquidity problem. This is called time risk. The third one is still worse, called is it a Damocles sword, because they are called non-fund based credit facilities, contingent liabilities, off-balance sheet items. They never enter. They never enter the balance sheet. They never enter your house, but still they create a big havoc. The day on which these commitments are given, there is no cash outflow. Today, a commitment is given, a bank guarantee, a letter of credit is given today. And every commitment has a due date. That is called your D-Day. On that D-Day, on that due date, the customer has to meet its commitment. If he is not meeting the commitment, then bank has to meet. I always, in previous lectures also I told, there's a phrase called when the horse is not healthy, the owner asks, why a horse is not healthy to the trainer or the fellow who is nurturing it. Sir, what I can do? I give him all food and all that, but he is not taking. If the horse is not taking, what I will do? This phrase will not hold good for bankers. If horse is not taking, the banker has to take in case of contingent liabilities. You have to gulp it. In banking guarantees, letter of credit, whatever is it, is what is happened in Nirav Modi scheme. All letter of comforts. When it got devolved, it has to be paid. RBI took a correct decision when PNB said that how it was given. Let us say we will not pay. Suddenly RBI said no, let us not go. Let it be centralized with you. You have committed, you pay. That's how it accumulated to 11,000 crores of call risk. So call risk is still worse because the day on which you think that there is no cash outflow, if you are dispersing a loan, you see cash outflow takes place. But in case of bank guarantee, letter of credit, no, the commitment only. We sign the commitment. On due date, the customer is not meeting, I am there, the bank is there. It applies to letter of credit, bank guarantee, whatever you say. So liquidity risk is highly challenging, short-term poisonous risk. Under that, again, it is classified into funding risk, time risk, and call risk. All these things are there. Whether treasury has to manage only rupee. When the cross-border transaction started taking place, in deposit itself, there are NRI deposits, FCNR deposits. What is the difference between NRI deposit and FCNR deposits? In case of NRI deposit, the foreign fund comes, it is getting converted into rupee. In rupee, the deposit is placed. And anytime it can be converted, reconverted into at the ongoing rate into foreign funds. This is a big challenge. So NRI comes, he puts NRI deposit for 5 years. Let us assume. So he comes with the dollar is converted, 5-year deposit is put. Again, before 2 years, he comes for a premature closure, let us think. Again, it has been reconverted into dollar. You not only require rupee fund, you require dollar funds also. This is a big challenge because we are in for liquidity risk in two currencies. And again, funds can come in FCNR. When I was in dealing room or back office, I'm talking of 1991, we had a scheme called FCNRA. In FCNRA, what RBI said that whatever the FCNR funds you don't manage, you pass on the funds to me. So funds management was left to RBI at that time. The dollar, mostly 90% it is to be dollar only. So all dollar, whatever you accept, you give it to RBI, and whenever you want demand from, because that liquidity problem of foreign currencies was managed by RBI. But RBI also found it difficult. It is not required. It is giving a big headache to me. Now, from 1992, they said that even FCNR funds you manage. Originally, it used to be called FCNRB. Now it has that AB, many persons would have forgotten. Now it's plain FCNR. All the FCNR funds the bank has to manage. It has to be deployed in the form of deposit abroad, or it can be used for giving exporters loan, because exporters get packing credit, pre-shipment credit, post-shipment credit in rupee. They can be given in dollar also. It means if an exporter is, the bank is giving a PCFC, pre-shipment credit in foreign currency. It means out of an exporter, there's a dollar inflow that may take 15 days, 1 month, because exporter is exporting the goods today and the goods will reach the importer's country. From there, the dollar has to come through the banking cycle. It may take 15 days, 20 days. But in PCFC, that is given today itself. It means dollar inflow has taken place already. When the export comes, actually it's a reversal of entry, because today the bank has given the same dollar to exporter. The exporter takes today the dollar, even though the dollar is going to come afterwards, because how bank is giving out of the FCNR fund, they give the dollar today. When the actual dollar comes, it's only reversal of entry. So RBI permits using the FCNR funds to be placed as investment deposits abroad. Use it for giving dollar loan or foreign currency loan. It can be given to the exporters. It can be given pre-shipment stage. PCFC is called a pre-shipment credit in foreign currency. It can be given in post-shipment also. It can be given in foreign currency also. Suppose somebody is importing plant and machinery from abroad in dollar. The bank can give a foreign currency loan in dollar, so that he gets a natural hedge, because he can pay the dollar out of his exports. They are all called foreign currency loans. So what I'm telling is that the headache for treasury is not only rupee, they have to manage the foreign currency also, dollar being the prime currency. Nowadays we get lot of inflows, because Canada big settlements are there. UK big settlements are there. Australia latest big settlements are there. New Zealand big settlements are there. With the result, there is an additional responsibility. You have to manage Canadian dollar. You have to manage Australian dollar. You have to manage New Zealand dollar. All these things also have to be managed. So for foreign funds management also rests with RBI. Beside this, entire forex management is with the treasury only. Probably the documents are handled at the branch level, B category. We call A category. If somebody know what is FEMA regulations, there's an A category branch, B category branch, C category. C category branch don't know anything on forex. It will only act as a post office. B category can handle only the document, whereas A category is a dealing room. It can handle the document, along with that it can the funds management also, forex funds also it can handle. That is called a dealing room. Dealing room is where the conversion takes place. Okay. Next is, so far 100% of the liquidity risk has to be managed by treasury. 100% of the forex management, including forex risk, has to be managed by treasury. Come to interest rate risk. Here some leeway is there, not 100%. Interest rate risk management, the prime responsibility, there's a committee called Asset Liability Committee. It monitors, and because The loans are given at branches, deposits are accepted at the branches. There itself your interest rate stocks. It starts from there itself. So Treasury's role is limited. It has to act as per the guidance of ALCO. It means there are many loans are there. I don't want to today itself keep you open for derivatives and all that. The interest rate risk, they are using derivatives. Treasury can manage the interest rate risk. Or using derivatives, it can create a open position, take a risk. Out of that also it can create money. All things are possible. That's what the opening remark Mr. Bhaskar was telling. After India adopting liberalization policy from 1991, interest rate in the bank has become highly volatile. Before that, it was not at all, because our economy was not unified with the international economy. What is the watchword now? Uncertainty is the new certainty. You are living in uncertain world. You are living in volatile world. Go back to when Sensex was 4,000, 5,000. The drop was 100, 200. Now, when it is reaching 60,000, the drop itself is more than 1,000. Such is the volatility you have to face. It means go back to 30 years in volatile market, don't enter. Now, what the present management guru said that you enter only in volatile market, there only you can make a profit. Volatility is going to be there. More and more the India getting liberalized, more and more foreign fund comes, more and more churning of funds takes place, more and more avenues for investments are there. Go back to 1991. If somebody wants loan, it was only bank. You want long-term loan, at the time, development financial institution will be there, ICICI, IDBI, like that. Nowadays, umpteenth opportunities are there. Bank is one of the source for raising loan. Bank is one of the place to deposit. So, interest rate regime has become highly volatile. And one more thing, almost till 2000, 2001, 2002, RBI has taken the role of fixing the interest rate. Deposit, RBI will fix the rate. Advances, RBI will fix the rate. Then RBI asked a question, 1947, you obtained your independence. How long you want I should act as a mother for you? You are already major. Can you not manage your own interest rate risk? So from 2002, RBI started coming out of all, you manage your interest rate risk. I am giving A to B, this is your leeway, within that you manage. In fact, 2010 was the last thing. RBI said that I am not fixing SB rate. SB rate also I am giving to you. And one more thing, that SB rate used to be once in 6 months, or the quarterly rates or half-yearly rates were there. Today, SB interests are paid on daily product basis. If you say smile for small finance bank, they are giving 78%. Public sector banks are paying 2.5 to 3%. This is the volatility. In SB itself, the volatility is, the difference between two banks is more than 6%. With all that, the banks have to accept deposit and give loan. This is the challenge nowadays. So today, entire interest rate risk on the bank, not on the treasury. So that interest rate movement, there's a committee called Asset Liability Committee. There are 3 committees working you should work as per RBI. One is Asset Liability Committee, and the Credit Risk Management Committee. Third one is Operational Risk Management Committee. In that, the market risk focus comes on ALCO. ALCO has to meet minimum monthly once. And if you see regularly, they meet once in fortnight. And whenever policy changes come, they meet. And here interest rate when treasury's role is limited, they have to obey what ALCO says. But in case of liquidity and funds management, there is no God. It's treasury itself is the God. They have to manage. Next is a very interesting thing, transfer pricing mechanism. You can see there are a number of branches that is situated in residential colony. When the residential colony is set up, I live in a place called Charkop. At that time, many housing loans are because residential colonies are coming up. Once a residential colony has been set up, there's no scope for giving loan there. You will accept only deposit. That's why if you see a branch situated in residential colony, their deposit will be more than advances. Whenever there is a target fixing, anything comes, your branch is not having advances. Now there are no scopes are except I cannot give, except consumer loan I cannot give. There are no corporates here. So a branch can accept, a residential branch it accepts a deposit, but it is not able to deploy the fund because advances chances are not there. So what that branch, it has to pass on the deposit to centralized full treasury. Now treasury will look for, there are places, go to Surat, go to Tirupur, go to Gurgaon, always funds needed. They are always hungry. How much money you give, we can deploy. That is the situation there. So most of the funds, surplus funds of the deposit are getting used by branches wherever needy branches are there. Now the year challenge comes. One Charco branch, residential, I'm just naming it, it accepts the deposit, it is not able to deploy it. These funds are now utilized in Ahmedabad or Surat. Now, the funds of this branch is enjoyed through treasury by another branch and they are earning profit. If no compensation is given to the deposit canvassing branches, it will go in loss. There are two impact here. It will go in loss, or whatever the deposit I am putting, some branch is using, my branch is going in loss. Why I should canvass? The motivation is getting affected. So here treasury plays a very high role. That is called transfer pricing mechanism. Now transfer pricing mechanism is highly complicated. If you go to banks, there are many things. I have taken a simple example, but let us not digress how it gets. Now the funds of this branch, C branch, is getting used by A branch. So some compensation is to be given to this branch. Now take the case, Charco branch Mumbai has accepted 200 crores for 1 year at interest rate of 4.75. Since this branch could not give advance out of these funds are transferred to treasury. Now, I told two impact. If some compensation is given to this branch P&L will be in loss. This branch will not have any motivation to go for canvassing deposit. That's why what treasury said, don't worry, you keep canvassing the deposit. Funds management is my duty. You don't worry. I will give you deposit plus 75 basis point. It means he's accepting at 4.75%, and in turn, the branch gets deposit plus 0.75%. Now the funds have come to, it means you knock it off interest rate, your deposit rate, you knock it off. Virtually, this branch gets 0.75%. That is the margin he is getting. On 200 crore, find out what is the margin. That is the profit made by this branch. Now the funds have come to treasury. I told you the first core function of treasury is funds management. Next core function is meeting the statutory presumptions. CRR 4% of the deposit, SLR 18%. Now I'm assuming, and the biggest thing I have been telling, the CRR with RBI is NPA for us, because RBI pays no interest on that impounded portion. RBI says you are accepting a current account, are you paying any interest? No sir, we don't pay. Then why I should pay? So whatever the money that is parked with RBI in current account, RBI is not paying any interest. Now SLR, I am assuming the deposit accepted 4.75%. SLR, I am assuming it is earning, because out of 18 crore, out of 20 crore, 18% will be 36 crores, and it is 4.15%. This is what I am assuming. Now let us assume there is no demand from the branches. Nobody is asking. This fund lies surplus. So first 20 days, this treasury is investing in money market at 3.85%. It is accepted the deposit 4.75. In money market is investing at 3.85. It's a negative return. But even this market is not there, they will get zero. That is called marginal cost principle. Kuch na kuch milta hai kya? Something you are getting. Now let us think on 21st day, Suddenly there's a demand. Ahmedabad branch A said that you give me that funds, I am ready to take. Now treasury is telling, yes, I have got funds. Out of 200 crores, I've kept 8 crores in CRR, 36 crores in SLR. The remaining funds you can enjoy, but it is not your fund. This fund has come from branch C. So you have to pay me some compensation. Now I'm introducing a new technique called cost of deployable funds. What is cost of deployable funds? It is not deposit rate. You have to account for two things. On 4%, the bank is not getting any yield. On SLR, bank is getting a negative yield. These two should be loaded on the deposit rate. Then only you will get the real cost. That is cost of deployable funds. You want to say formula, cost of deployable fund is cost of deposit plus negative impact arising out of CRR plus negative yield arising out of SLR. In CRR portion, we don't get any interest. In SLR portion, bank is getting some interest, that is negative. This should be adjusted. Okay. Now, Ahmedabad said that, okay, I am ready to take the funds. Now, treasury is putting a condition. You have to pay me COD. COD short from cost of the plus 1.75%. We are going to work out cost of deployable funds. I'll teach you how to work out. And what is the carrot for Ahmedabad branch? They are ready to lend to the borrower at COD plus 3.25%. It means you knock off COD, 3.25 minus 1.75, that is the margin for Ahmedabad. They are taking the risk. Okay, let us do first. C branch has accepted 200 crore, it has accepted at 4.75%. This is the interest they have to pay. If anybody has got doubt, please ask me. This is mathematical problem. You stop me, I'm ready to stop. And since these funds are transferred to treasury and they are charging deposit plus 0.75, it means this is the 11 crore C branch will get from treasury. It means 11 crore is the revenue for C branch. Their expenditure is 9.5. They are making a profit of 1.5 crore. Now C branch is happy. Even though I am not lending, good year, I will canvas further. I don't take any risk also. I pass on the money to treasury and my books are in profit. So you are satisfying the branch which has sourced the deposit. Now, let us see, I told you what is cost of deployable funds. You see, the interest paid is 9.5 crore. It is here. You can see in this slide at 204.75, the interest paid is, that is payable. And bank has kept 18% of 200 crore. That is kept. So on that SLR, you can see here I am telling on SLR bank is getting some 4.515%. So this is the income from SLR. So interest paid is a cash outflow. Interest received on SLR is a cash inflow. You net it 9.5 minus 1.49. What is the net you have to find out? Okay. So, and one more thing, 20 days it has been invested in money market. That also I am factoring. You can see here 156 crores because this is after keeping SLR and CRR. 8 crores is kept with CRR and almost your 18% of 200 crores. Somebody can take the calculator and work out. Please. 200 crore into 18. So 36 crores is kept in SLR and again remaining 156 crores is invested for 20 days at an interest at 3.85. So the cash outflow is 9.5. Cash inflow on SLR is 1.49 interest inflow and money market inflow is 0.33. Now, what is your net cash outflow? 9.5 minus these two. 7.68 is the actual cash outflow of the bank. What is the loan? What is the amount transferred to A branch for giving loan? This is the loan given. This is the net cash outflow. Now solve this. It comes to 4.92. At what rate bank has accepted the deposit? 4.75. At what rate it is coming? 4.92. What is the difference? Can you find out, please? Anyone? 4.92 minus 4.75. 0.17 difference comes. What is this 0.17? This 0.17 takes care of interest bank is not getting on CRR portion, and on 36 crore that is invested in SLR, there's a negative yield because bank is paying 4.5, whereas on SLR they're getting only, bank has accepted deposit 4.75, on SLR they're getting 4.15 only. There's a negative return, you can say 60 basis point negative return. All these things got accounted, and that is from 4.75. This is called cost of deployable funds. It means it has gone up. So don't at all think, my dear friends, deposit is your cost. No. Deposit plus negative impact arising out of CRR and SLR is to be accounted. That is the formula here. Okay, if you got any doubt, please ask me, because it is there in MCQ also. Okay, now cost of deployable funds is 4.8. Anybody has got doubt, please ask me. Otherwise, I'll go further. Okay. Now go to Ahmedabad branch. Ahmedabad branch, Treasury has given 156 crores and Treasury is charging COD plus 1.75. This is what the expenditure of Ahmedabad branch. And this is the loan. 156 crore is given to a borrower at cost of deployable of 3.25. It means if this is a performing loan on due date, the interest income is 12.05. Out of this branch has to pay 9.84 to Treasury, because this is the fund that came through C branch. So Ahmedabad is making, A branch is making a profit of 2.21. Now he is also happy, because what is the opinion of A branch? I have not sourced the funds, but I got a funds from Treasury. Still I have invested it. So I have not canvassed it. I will not say that goes negatively. He has not canvassed the deposit. To that extent, his work is less, but he's enjoying somebody's funds. For that, he is paying a compensation, and Treasury makes in such a way he is in profit. Now, Treasury has made the deposit accepting branch in profit. Treasury has made the branch which used the funds also in profit. Finally, Treasury should not land itself in loss, because Treasury is again a profit center, which I am going to discuss subsequently. Nowadays, Treasury is an independent unit. It has got a volume. It has got a target. Every dealer has got a target. Accumulate the dealer's target, it becomes the Treasury target. That's a profit target for them. So Treasury also should see that I should have my pie. I should have a cut. Now, what is the Treasury income? Interest received from SLR, which we already worked out. Interest, 20 days, these funds are invested in money market. This is the interest they got. This is what interest they got from A branch. Total all these things. And this is what Treasury has paid to C branch, deposit accepting branch. So they are making a profit of 66 lakhs. Transfer pricing mechanism, the Treasury should ensure that the deposit accepting branch should also be in profit. The deposit utilizing branch, the funds were utilized that for giving advance, that should also be in profit. Treasury should be in profit. When all three things are in profit, automatically bank will be in profit. So another way to prove profit made by deposit accepting branch, profit made by the branch which utilizing the fund, it has given the loan, 2.21 crores, profit made by Treasury, total all these things. This is a thumb rule. The two figures should tally. Here also I am getting 4.37. Another, when these two tally, your working is correct. It means it's the profit and loss account of the bank, and a shortcut, whether I did correctly, whether somewhere you go wrong, these two figures will not tally. So what is the crux of transfer pricing mechanism? Deposit taking branch should be in profit, as otherwise they will not canvass deposit for the bank. Advancing branch using the funds of other branches should also be in profit, because they are taking the risk of finding out a suitable borrower and earning interest income for the bank. I am the one, I am doing it. That's what advancing branch will see. Treasury, which is regulating the funds in the process of mediation, it should also be in profit. Treasury's ultimate goal should be in the transaction. It should ensure whole bank should be in profit. The final topic of the day is, having seen all these things, is treasury a cost center or a profit center? I already told, prior to 1991, the forex department was attached to a branch. Investment was kept in at the head office. They were working in different silos. What is happening there, they don't know here. But with 1991 liberalization coming, rupee being the common thread that united all the departments together, after 1991, there is a trading chance also it has come. Every dealer is given a trading target to trade efficiently in such a way you make profit. You can ask me if they can make loss also, that I will teach you what is stop loss and all that afterwards. But trading is also permitted. So nowadays, yes, it was a cost structure prior to 1991. After 1991, Treasury has become a vibrant department. I will say vibrant independent branch, moving the funds, not only domestic, foreign funds also, and very high volumes are churned there. They are responsible for keeping CRR and SLR. Now, prior to 1991, two departments were there. It got united. All these things were kept under one roof. And the present thing is that Treasury is a profit center. And every bank looks a big profit from Treasury, particularly when yields are coming down. Treasury will make a big profit, because price and yield has got inverse relationship. You buy a bond today, afterwards the yield has come down, you can sell the bond at a profit. And my worry is that now everywhere US is going to raise the interest rate. All are looking for rising interest rate. Now, if RBI raises the interest rate and US raises the interest rate, the treasury profit will be a big problem in March. When the yield goes up, you will be selling the bonds at a loss. Mark-to-market valuation will be in loss. So a question comes, presently, Treasury is a cost center or a profit center. You can boldly say Treasury is a profit center. It has got a volume. It has got a target. It's an independent unit. It has a balance sheet. It has a P&L account. So you can measure the performance of the Treasury. You can measure the performance of the dealer. All these things is possible nowadays. There are softwares available. All things are there. So Treasury is a cash cow for the bank. That's what that day Mr. Ramarao was also telling CGM. Treasury, we look for big profit from them. So Treasury is a cash cow now. It's a profit center. So with this is an introductory talk for Treasury. Sir, I'm handing over to Mr. Gulati.
Thank you very much, sir. What an introduction to the Treasury operations. Very nice, friends. Such an introduction we have never heard from anywhere else. So nice. Thank you very much.
Thank you, sir. Thank you, sir.
Thank you, sir. Before I take the question answer, so we have pleasure that we have with us Mr. Bhaskar Sen, former CMD, United Bank of India.